January 30th, 2026, 9 a.m. New York time. Gold had just hit $5,500 per ounce, an all-time record never seen before. Silver surpassed $120, more than 3 times its value from a year ago. Investors worldwide were celebrating. It was the gold rush of the 21st century. And then it happened. Within a matter of hours, gold plunged 11%, silver 37%. Billions of dollars evaporated, investors liquidated, funds collapsing. The biggest drop in 4 decades, the worst crash ever recorded. But here's what nobody is telling you. This wasn't an accident, it wasn't a coincidence. It was planned, and it started with a single decision in Washington. In this video, you're going to discover exactly what happened behind the scenes of this financial catastrophe, how investors lost fortunes in minutes, and why this might just be the beginning. But before I show you what really caused this collapse, you need to understand how we got here, because this story starts long before January 2026. It starts with fear, uncertainty, and the biggest speculative bubble in precious metals in modern history. And all of this was about to explode. Let's go back 1 year in time, January 2025. The world was scared, wars spreading, currencies devaluing, inflation still haunting economies. And when people are afraid, they run to gold. From $2,000 in 2024, gold went to $3,000, then $4,000, then $5,000. China went heavy, central banks worldwide stockpiling, regular investors buying like there was no tomorrow. But silver? That went beyond, from $40 to $120 in less than 12 months. Now, pay attention to this chart. See how it's almost vertical? This is what economists call a parabolic move, and you know what happens after parabolic moves. They burst. The market was completely leveraged, funds borrowing money to buy more gold, investors using derivatives, massive bets being placed. It was a matter of time. All that was missing was the trigger. January 28th, 2026, a seemingly normal Tuesday. Gold was at $5,500, stable, confident. Analysts predicted $6,000 by March. Some talked about $10,000 by year's end. Investors celebrated extraordinary gains. It was pure euphoria. And then, on Thursday, the 29th, everything changed. 6 in the morning, Washington time. The news explodes. Donald Trump had just nominated Kevin Warsh to lead the Federal Reserve. Now, if you don't know Kevin Warsh, let me explain who this man is. Former Fed governor during the 2008 crisis, known for being tough on inflation, a defender of high interest rates. The market expected someone more flexible, someone who would cut rates, weaken the dollar, favor safe haven assets. Instead, they got a hawk. The reaction was instant. The dollar surged, and when the dollar rises, gold and silver fall. It's simple math, because gold and silver are priced in dollars. A stronger dollar means you need fewer dollars to buy the same amount of metal. But there was more. With Warsh in command, the probability of interest rate cuts plummeted.
And here's the problem. Gold and silver don't pay interest. If you can get 6% a year in US government bonds, why would you hold gold that pays you nothing? The first investors started selling. Thursday night turns into Friday morning, and what was a correction becomes a catastrophe. The drops trigger automatic selling systems. Margin calls explode. Leveraged funds are forced to liquidate positions. 10 a.m., gold down 5%. 11 a.m., down 8%. Noon, down 11%. Silver is worse, much worse. Down 15%, down 25%, down 31%. From $119 to $70 in a matter of hours. It's the biggest single-day drop in 4 decades for gold, and the worst crash ever recorded for silver. But the pain didn't stay just in physical metals.
Mining companies saw their stocks collapse 30, 40, even 50%. Commodity-focused funds lost years of gains in a single day. And regular investors? Some lost everything. Life savings, retirements, dreams. The CME, the Chicago Futures Exchange, increased margin requirements, forcing even more selling. Monday arrived, and the bleeding continued. Gold below 4,700, silver in the 80s. Let's put the size of this destruction into perspective. Gold fell about 20% from the top, silver more than 30%. In market value, more than $200 billion simply evaporated. To give you an idea, it was bigger than the 1980 silver crash, bigger than the 2013 crash, bigger than anything we've seen in a generation. Silver's volatility hit levels seen only in extreme crises. We're talking about moves of 10, 15% per hour. But not everyone lost. Some traders saw this coming. They bet on the fall and made fortunes. Some central banks that sold gold weeks before breathed a sigh of relief. And some long-term investors, they simply held. Because even with the crash, prices were still double or triple where they were a year ago. So the big question everyone is asking now is this the end or just the beginning?